Just as expected, inflation came in hot and is still above the Fed's target and seems to remind everyone that it's not going away quietly. In the meantime, mortgage rates reacted, housing data came in mixed, and buyers are still trying to figure out what happens next. Good afternoon. Well, I hate to burst the bubble, but just as many investors feared, the peace talks appear to have fallen apart. Tensions escalated over the weekend after Israel increased military operations against Lebanon, prompting Iran to reject any remaining negotiations and announce plans to close both the Strait of Hormuz and the Bab al Mandeb Strait, two critical shipping routes to play a major role in global energy supply chain. As a result, oil prices climbed back above $90 a barrel, while the 10-year Treasury moved back up into the 4.45% range, putting additional upward pressure on mortgage rates to start the week. The bigger picture here continues to be inflation. The market just isn't reacting to geopolitical headlines themselves. It's reacting to what higher energy costs could mean for inflation moving forward. The real question now becomes not only what the ultimate impact of this oil crisis will be, but how long it will last. Outside of everything happening in the Middle East, we also received some housing data this week that continues reinforcing why real estate remains one of the strongest long-term wealth building tools available, even in the face of higher rates and affordability challenges. Let's dive into what took place last week. Here are your headlines. The inflation data this week was a bit of a mixed bag. On the positive side, the Fed's preferred inflation gauge, core PCE, came in slightly cooler than expected at 0.2% for the month, which was a welcome sign for investors hoping inflation is starting to move in the right direction. However, when you zoom out and look at the annual numbers, inflation is still proving to be much stickier than the Federal Reserve would like. Headline PCE rose to 3.8% year over year, while core PCE ticked up to 3.3%, remaining well above the Fed's 2% target. What stands out to me is that the market continues to find itself caught between two competing narratives. On one hand, there are signs that parts of the economy and labor market may be slowing underneath the surface. On the other hand, inflation continues showing enough persistence to make the Fed hesitant about cutting rates too quickly. The other wild card remains everything happening in the Middle East, with oil prices remaining elevated and uncertainty surrounding global energy supply. Investors are still very sensitive to anything that could create additional inflation pressure moving forward. The bigger picture is that Fed still doesn't have a clear path forward. Inflation is improving, but not fast enough to declare victory. That's why all eyes will now be on Kevin Warsh in his first Fed meeting on June 16th and 17th, as investors look for clues whether the focus will remain on fighting inflation or concerns about economic growth begin taking center stage. Now, in housing news, home prices continue proving to be far more resilient than many people expected, even in the face of higher interest rates. According to the latest data, home values were essentially flat to slightly higher over the last month, depending on which report you look at, while still posting annual appreciation of 0.7% to 1.7% across major housing indices. What's interesting here is that while home price growth has definitely slowed compared to the double-digit appreciation we saw during the pandemic years, prices are still moving in the right direction despite higher mortgage rates and ongoing affordability challenges. The bigger picture is that real estate continues doing what it has historically done over long periods of time, steadily building wealth. In fact, the latest forecasts from more than 150 economists, housing experts, and market analysis are calling for home prices to rise roughly 14% over the next 5 years. To put that into perspective, a $500,000 home could gain approximately $70,000 in value during that time. This is another reminder that while buyers focus heavily on today's interest rate, long-term homeowners often benefit more from time in the market than trying to perfectly time the market. Now, new home sales pulled back in April, falling 6.2% from the previous month and coming in below expectations. At first glance, that might sound concerning, but I think the story is a little bit more nuanced than the headline suggests. The market seems to be realizing that affordability remains to be the biggest obstacle for buyers right now. Higher mortgage rates, elevated gas prices, and overall economic uncertainty likely have caused some buyers to hit the pause button during April. That said, underlying demand for housing still appears to be there. What we're continuing to see is that while new home sales slowed, inventory of completed move-in ready homes remains surprisingly limited. Out of nearly 489,000 new homes available for sale, only 122,000 were actually completed and ready for occupancy. The rest were either under construction or haven't even been started yet. So the bigger picture is that housing supply remains one of the biggest challenges facing the market. And lastly, the latest economic data continues telling a story we've been talking about for several months now. The economy is slowing, but it's not slowing nearly as fast as many people expected. GDP came in at 1.6%, which was slightly lower than forecast, but still a noticeable improvement from the 0.5% growth we saw at the end of the year. The takeaway here is that AI investment and technology spending have continued to help support economic growth, even as higher interest rates and affordability challenges put pressure on consumers. Now, as we head into a new month, the market continues trying to answer the same question it's been wrestling with for much of the year. Is inflation coming under control, or is the economy still strong enough to keep price pressures elevated? This week should provide some important clues. We'll get a fresh look at the labor market with job openings this morning, private payroll data on Wednesday, and weekly unemployment claims on Thursday. Then all eyes will turn to Friday's job report, which includes both non-farm payrolls and the unemployment rate. What stands out to me is that investors are still searching for direction, and this week's employment data could go a long way towards shaping expectations for where mortgage rates head next. We'll see what the numbers tell us, but for now, have a great rest of your day, and I'll be talking to you next week.